Hello and welcome back to the ROI channel, the channel that is obsessed with everything to do with the art and science of return on investment. Thank you if you have liked and subscribed already. If you haven't, I'd really appreciate it if you could do so. Thank you to the guys who are already following and copying the portfolio on eToro. It's a great vote of confidence and I really do appreciate it. It's going to be a lot of fun. So far I've had a lot of love for the videos, and so if there's anything you'd like me to cover, please let me know in the comments and we'll eventually get to it. Got quite a bit on my plate. Please see the disclaimer at the end of the video. Not that you would be silly enough just to rush out and buy something that I've talked about on the channel, but just a little bit of housekeeping there. And we're going to get straight into it today, talking about one of the stocks that I believe has a humongous upside potential, and that is, of course, Fortuna Silver Mines. It trades on the New York Stock Exchange and it's listed on the Toronto Exchange like most of the natural resource companies. It is incorporated in British Columbia, but it has mines all around the world. It was mainly involved in South America and now has moved over into Africa, which we'll talk about. As you know, any of the stocks that make it into the portfolio have to run through our investment formula, and you can see through here what it is that we're looking at. This is one that meets all of the criteria, and so I'm very, very excited. Now, when we're talking about a commodity producer, essentially their earnings are really tied to the price of the underlying commodity which they sell. In this case, it's mainly silver. They do, as a byproduct, produce a little bit of gold, but they're mainly after silver. I will do a separate video going into depth on the macro views that I have for precious metals. But for today, it's important that we get a little bit of understanding as to this, not only demand pressures on silver in particular of all the precious metals, but also the supply crunch that we've had from decades of underinvestment in mines, and also due to COVID, this stop of production where a lot of mines had to cease production. So it's hugely bullish, in my opinion, for the spot price of silver. And as you'll see in a moment, what that does to a silver producer produces outsized returns due to their leverage of the commodity. I won't go into too much depth as to the macro view today, but if you look at this chart here, which is from a fabulous website, goldsilver.com, with Jeff Clark and Mike Maloney do a great job talking all things precious metals. So I encourage you to check it out. We're looking at a relative valuation of silver to the S&P 500, or one of the main indices of the US stock market. As you can see there, you've got, if you follow my cursor, there are times when silver is expensive relative to the S&P, and then times where silver is absolutely dirt cheap, historically speaking, when compared to the S&P 500. It's really interesting. Most people out there only think of pricing assets in dollars, okay? But what happens if the instrument in which you're measuring or pricing assets is a floating abstraction? And that's exactly what the dollar is. Any fiat currency is. It's not backed by anything anymore. In the past, it's been backed by gold standards or silver standards, traditionally have been even more commonly used. And so what this chart is demonstrating is how many shares of the S&P 500 index would an ounce of silver buy, okay? So when the price is higher, obviously that's when stocks are cheaper relative to silver, and when it's lower, vice versa, okay? So it's interesting always to have a different way of valuing assets using ratios, okay? This chart here is a showing of the commodities and their performance since the highs of 1980s. So a quick crash course in history. 1970s was a period of very high inflation in the United States. One of the reasons being that August 15, 1971, Richard Nixon temporarily suspended the convertibility of US dollars for gold, or their gold equivalent. Okay, so what that means is that the dollar was no longer anchored to the price of gold. Okay, all the other currencies around the world were anchored to the US dollar under the Bretton Woods system. The dollar was anchored to gold, and then Nixon cut the ties And ever since, we have had this kind of floating abstraction of currencies, which of course can lead to opportunities or for disaster, depending on how prepared you are, because we tend, as I mentioned before, we tend to price things in currencies rather than using fixed assets. So enough of that. What that means is, since those ties were cut, look at what's happened to commodities. We are experiencing, I believe, the dawn of a super cycle in commodities, if for no other reason than the fact that monetary and fiscal policy with governments all around the world is really being financed by their central banks, which is a recipe for long-term inflation. Okay, so even if you're not as bullish on the supply-demand scenarios around a given commodity, the very fact that the dollar, in this case, in which you are pricing that commodity, is weakening, will strengthen the price of that commodity on a relative basis. Okay, so as we can see here, if you follow my cursor, you can see what's happened, the movements in each of these respective commodities. I won't go through them one by one, but you can look up the chart from the London LBMA, or you can go to gold, silver. And we look where silver is trading right now compared to its previous high. And this is, in my opinion, severely undervalued for many, many reasons. There are so many drivers, particularly for silver. When you think about the electrification of things, it uses a heap of silver. Silver is a really important conductor of electricity. So all the electric vehicles coming online, solar panels, etc., is rapidly increasing the demand for silver. And what's unique about silver compared to gold is that both can be used as money, so they have a monetarily purpose, but silver is far more industrial. Okay, so if you think about the supply and the demand, when you're looking at silver, there's huge demands already for industry, and that's continuing to grow with A, population growth, and B, the electrification of things. We need so much silver. The supply of silver is more plentiful than gold, but it's doing those two functions. Okay, it's performing those two functions. It will act as money in some circumstances, and it also has industrial demands, which means that the supply gets eaten up all the more quickly. Okay, when you have this perfect storm of demand increasing and supply decreasing due to, as I said before, a lack of investment in the sector, and COVID has literally put the brakes on the production of many commodities around the world. I know you're talking to local builders, you cannot get steel, you cannot get timber. Lumber futures, although they've cooled off recently, absolutely took off parabolically at the start of the year. And this is what we're seeing with commodities all around the world, is a supply-demand imbalance. A lot of their prices have taken off, though, as you've seen, except for silver. So in my humble opinion, silver and possibly one other commodity that is not listed on this table are the most undervalued commodities in the world right now. Moving on to another way of valuing silver, which is, of course, relative to gold. Silver will track gold historically. If you look here, the blue line is the spot price of silver, okay, which is what the miners will use. If you look at the yellow line, that's the gold to silver ratio, okay? So how many ounces of silver does it take to buy 1 ounce of gold? March 2020, that's the peak there. Everything fell off a cliff, and silver devalued massively compared to the price of gold. So if you listen carefully, if you lived near me around this time, you could hear the beep, 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 the reversing of a truck backing back. And that was me buying up as much silver as I physically could fit and afford into the damn truck. Okay, that was historically way too cheap for silver. Normally you're looking at a 12 to 16 ratio, okay? And obviously it doesn't take a genius, in my opinion at least, to work out that 120 was way too cheap. 120 ounces of silver for 1 ounce of gold is undervaluing silver. So why is that important anyway? Aren't we talking about stocks? Well, yes, we are. We're talking about a particular stock today that is a silver producer. So it's not an explorer. They have exploration projects, but this is important. They actually have some silver, okay, which is important. here I've got the gold miners index to the price of gold as percentage change. And I know it's gold, but the silver functions the same way. This was just a better chart that I could find. Here you've got the increases in the price of the gold spot, okay? And then above, you'll see the miners increasing more, okay? So for every, it's basically a 2x relationship here. For every dollar that the spot price increases, you're magnifying that 2x to the bottom line of these companies, okay? Let's examine that. Here is a, oh, there's a spelling error there. Here you've got the price structure of a lot of different types of businesses where you have your fixed costs, so maybe your rent and your overhead, whatever the case may be. Your variable costs will be service providers. So let's say you're in a business like physiotherapy, for example. Every time your business grows past a certain point, you have to put another provider on. And so yes, your revenue increases, but what you'll find is that your variable costs also increase in lockstep until you hit a saturation point for the physical premises, okay? Compare that here to the way a commodity producer functions, or also software businesses are very similar. We have the spot price, okay? So as the spot price increases, you still have your fixed costs. Your variable costs may or may not go up. And look what happens. As the spot price hits past the level of your fixed costs, your profit starts to go parabolic, okay? Meaning it's not a one-for-one relationship. You might have a 3, 4, or 5x for every dollar that the, say in this case, the silver price rises, and you're going to see in a moment, that may add $5 to $6 of EBITDA to the company. And this is a huge deal, okay? Where you've got fixed costs, when it comes to commodity producers, they mainly measure this in something called an all-in sustaining cost, okay, AISC. It's about $950 per ounce, or per gold ounce equivalent for Fortuna Silver. So for every dollar that the commodity goes north of that, you're going to have this positive disconnect, and the delta between the two will go straight to the free cash flows. And we're going to get paid as equity holders on that increased free cash flow and a multiple of that free cash flow because it's traded on the public market. So if people want to buy our share of the business from us, they will have to pay us a multiple of the free cash flows. And if those free cash flows are going through the roof, so is the multiple. Okay. So let's get into it. Quick facts for Fortuna. Does it hit our target of sales growth? Let's have a look. So revenue has compounded over the last decade at a compound annual growth rate of 17%, which has been really good because you have had some ups and downs as all commodities do. They're cyclical, and that's very, very good. It's forecast to increase almost 70%. 70% increase over the next 2 years, which is obviously interesting to say the least. 20% increase in the EBITDA. Now, here's something of note. When your EBIT is increasing at a faster rate than the revenues, that means your margin is expanding, okay? So you're not only selling more, but you're making more profit off what you're selling. Shares outstanding, return on capital 12%. That's pretty good for a miner. Miners are the most horribly capital expensive businesses. You think what it takes to open a mine, think how long it takes. It is part of the reason why no one has invested enough in certain commodities over the last decade, because it just costs so much. And when the spot price has been depressed, which it is, you have this situation where no one's investing, opening up new mines. It means that no one's putting more silver, in this case we're interested in silver, back on the open market, and so demand is staying the same or increasing, and supply is just dwindling, and miners will not explore, they'll not look to open new mines, they'll not look to increase production of their existing mines until the spot price increases to a point in which that becomes financially viable. Market cap, enterprise value, and total debt to EBITDA is 1.2 times. That's great. That's less than our 3 times rule, which is good. Net debt to EBITDA is less than 1% on this company, which is very good. Buyback ratio has been very good over the last few years. However, they have issued more shares than they bought back recently because they have taken over a project. And we'll talk about that in a moment. The share price has been beaten up. Okay, it's now $4.35. If we move over here, this is the last year. Okay, it's more than half off the tops. Okay, it's been absolutely bashed, which is an opportunity as long as we're confident that we have the underlying fundamentals to support our thesis. It could mean that the market's thrown the baby out with the bathwater and given us an opportunity. Short-term forecasts into 2022. I'll plug my laptop in there before it passes out on me. Okay, here's something very important. Earnings per share, this is the analyst expectations of end of this year, so end of 2021. And we're looking at, end of 2022. We're looking at earnings, free cash flows, and the expected EBITDA, okay? And I've did a very, I believe, a conservative multiple on each. I've taken the industry median at this point. Fortuna is trading well below the industry median. So I'm saying, okay, this is what the company is expected to hit. This is what you would normally expect to pay for those earnings, EBITDA, or cash flows in the sector. And what does that implied price look like in each scenario? What is the upside? And we've just done a simple average of the three cases there. So as you can see, we're looking at, if this is correct and everything else is equal, we're looking at a 3.5 times on the upside in a little over 12 months. Okay, so obviously that's an exciting prospect, but of course there's those little bits of uncertainty, if not risk. And we're going to talk about that in detail. Fantastic article about this particular company. I would highly recommend people go and read it. We'll quickly go through some of the main talking points. Obviously, you can read the article. I'm not going to read it to you. Let's have a look in particular at this graphic, okay? So here's where Fortuna is, okay? In terms of, you remember I said all-in sustaining cost. That's how much it costs the company from go to woe, all their expenses, into a cost per ounce produced, okay? And as you can see here, we're not paying for some risky high cost producer. We're paying for the lowest cost producer. That's insane. This is crazy. Pan American, First, Majestic get a lot of press, and yet Fortuna is the lowest cost producer out of the lot. If you look at the expected EBITDAs, Pan American, if you don't know, is an absolute giant of a company, okay? As far as I know, it's the largest silver producer in the world. Fortuna is a step behind that, and yet when you look at the price you're paying an absolute fraction for Fortuna that you are for Pan American. Now, is Pan American a better company? It probably is on the whole. However, here's a very, very important point. I'm sure you at home have been following the elections in Peru very, very closely, as have I. Unfortunately, Peru has decided that prosperity is not for them, and they've elected a socialist government. Now, this is disastrous for any kind of enterprise in a nation or in a government structure like so. Those types of governments, historically speaking at least, tend to steal assets from private companies. They either do it by taxation or they do it by nationalization. Pan American is way more exposed to Peru than Fortuna. Fortuna is exposed, but to a much lesser degree. In fact, less than half than that of Pan American. Okay, we're looking here at what they can produce. They're not the biggest, but again, they're in the middle. They produce enough, and thanks to this new merger that they're doing, and their free cash flows right alongside Pan American. As we go down, bear with me, this is important. Here we go. So another upside this company has is that it could potentially be a very juicy, attractive option for a buyout, okay? Look how cheap this company is trading, okay? These are the earnings multiples that you're paying. So if we look forward 1 year, next year's earnings to the current share price, we're paying a little over twice the earnings. Okay, extremely, extremely cheap for a publicly listed company with such upside. And chances are that the Pan Americans of the world and some of the other miners mentioned here may simply look at it and go, do you know what? It's so much cheaper just to buy out an existing miner like Fortuna. Let's just buy them out. Why would we look to explore and take on all the risk of unknown exploration costs? Let's just buy them out. They're trading so cheap. So they could put forth a hostile takeover, easily twice the price of the company's current trading price, which would force the board of directors to seriously consider that offer. Okay, so that's another little upside that we have on this particular stock. Now, when it comes to the valuation, here's what I've done. I've run through the expected free cash flows for end of 2021. I've applied the analyst's growth rate under three different scenarios. I've given them a haircut in each. Historically, this is the growth rate, 23% for the free cash flows over the last decade. What I've done is I've said, well, okay, what if they can just be consistent with that over the next 5 years? And then I've cut it in half, which is too conservative. I've done it anyway. We're discounting at a 20% discount rate, okay? Which again will give us an intrinsic value at or below which we must purchase the shares in order to receive that 20% IRR that I spoke about in the other video, which is our target, okay? Again, I've been conservative on the bullish case, and I've been overly bearish on the bearish case. And down the bottom, this is an expected value. So we get a probability weighting. We give it an expected value of the present value of those cash flows discounted back to today's dollars. Here's what the free cash flow looks like. Here's if you use an earnings model, okay? Then what I've done here is I've said an average between the two. What would that be? If we want to achieve a 20% return on invested compounded year on year, we've got to buy it below $17.5. And I've even gone further and said, well, what is a margin of safety on this company? Okay, so that's 66% of what the intrinsic value of the company is. Okay, so we've got a 33% margin of safety on the intrinsic value, and we can still buy it well below that. Okay, which is why I own Fortuna in the fund and in my personal account as well. Enterprise value to EBITDA, again, same idea, you get the picture. I've run through the numbers, okay? You can use your own analyst numbers if you wish, and apply your own scenarios and give it your own weightings. Again, either way we dice it, and this is what I do with each position in our portfolio. I take it through, I pull it apart, and we run it through every scenario that I can feasibly think of. And if at the end of that we still think, hey, look, the odds are everything is stacking up, then it gets a position in our fund. Okay, which leads me to the last or second last of the slides, which is, does this meet our formula for investing? Yes, it's got low debt, it's got a humongous margin of safety, sales are growing, margins are growing, free cash flow is growing, share buybacks is good enough, especially for a miner, so they treat us fairly well as shareholders. And I'm going to put in probably more like 2% of assets under management. That will be our exposure to silver. We also have some exposure to gold stocks, which I will talk about in another video. I'm going to leave it there because we're starting to take up too much of your time. If you enjoyed my investment philosophy, please, you might consider copying or following the portfolio on eToro. What happens if you're not familiar? I'll move my head out of the way. Click on the link that will be in the description. You'll come through to this page here on eToro. My internet for some reason is continuing to load, but you get the idea. There'll be the name of the fund, there'll be a picture of me and my name, and then there'll be an option to copy, and then you can transfer however many funds you believe the portfolio may be worth in terms of copying. Have a wonderful day, and if there's anything you'd like me to cover, please leave it in the comments. As always, take care, all the best with your investing, and we'll be back for another video soon.